Welcome to this Spokane housing market update. It's November 2022. The midterms have come and gone, the Fed has raised rates again, inflation is still staggeringly high, and as always there's no clear consensus on what's happening in the housing market. So it's time to check in and see what's actually happening with the housing market both nationally and locally here in Spokane. My name is Phil Wells, I'm a real estate agent that likes to keep up to date with the market, and I want you to be as informed as possible too. In this video we're going to be looking at national pending home sales, we'll look at mortgage rates as well as mortgage application rates, and we'll look at data from the Spokane market itself. We'll then move on and look at some real estate and macroeconomic news that stood out to me this month, before trying to piece it all together at the end and seeing if we can summarize the market as we see it right now in November 2022. So let's get into it. Looking first at national pending home sales for existing homes. Just a note on the figures that I used throughout this entire video, they are the latest figures that are available, but there is often a lag when it comes to reporting this data, particularly at the national level. For example, these home sale figures that we're going to look at are from September. Contract signings were down 10.2% month over month in September 2022. Year over year, contract signings declined 31%, which represents 16 months of consecutive year-over-year sales declines. This also marks a 10-year low for pending home sales. Where I am in the western region, sales decreased 11.7% on a month-over-month basis, and they declined 38.7% from the prior year. Those are massive year-over-year declines. Remember, last year we were facing a huge inventory shortage. We're now seeing a situation where sales are 30% below what they were in 2021. And at the same time, inventory is increasing. If you are an investor or a cash buyer or just a regular buyer that's been sat on the sidelines waiting for your time to strike, then with supply increasing like it is and demand waning like it obviously is, then now might be the perfect time for you to come in and snatch up a great deal. Here's what the National Association of Realtors chief economist had to say about September's pending home sales. Persistent inflation has proven quite harmful to the housing market. There's an understatement. The Federal Reserve has had to drastically raise interest rates to quell inflation, which has resulted in far fewer buyers and even fewer sellers. This economist noted that new home listings are down compared to 1 year ago, since many homeowners are unwilling to give up their rock-bottom 3% mortgage rates that they locked in prior to this year. The new normal for mortgage rates could be around 7% for a while. On a $300,000 loan, that translates to a typical monthly payment of nearly $2,000, compared to $1,265 just 1 year ago, a difference of more than $700 a month. Only when inflation is tamed will mortgage rates retreat and boost home purchasing power for buyers. I just wanted to pick up about what this economist said with new listings being down and what I said before that about inventory being up. Both can be true at once, this isn't contradictory. Nationally, we're seeing inventory up 33.5%, while, as this economist pointed out, new listings are down. The conclusion is that fewer real estate transactions are taking place, meaning that homes are staying on the market longer, thus swelling the existing supply of homes available to purchase. The point that this economist makes about interest rates absolutely blowing out people's purchasing power is 100% true, which adds more credence to what I was saying before, that if you've been waiting on the sidelines, particularly if you're a cash buyer, then now is the time to swoop in and get yourself a great deal. Let's move on and look at mortgage rates. The majority of home buyers in the United States are buying with the aid of a mortgage, so to keep an eye on mortgage rates can give us a really good idea of what direction demand is heading in. Rates are also in constant flux too, so by the time interest rates make the headlines, they're already out of date. The best we can do is to look at trends, and that's what we'll do now. Sticking with September for a second, mortgage rates at the start of September were at 6.23%, and by the end of September they were at 6.75%. The most recent rates I could see have risen again to 7.21%. We are now firmly in the 7% range for mortgage rates. Projections from the National Association of Realtors show that interest rates could rise to 8.5% from here. There are loan products out there to help you combat current high interest rates. The most popular is the 2-1 buy down. Effectively, you get a lower rate for the first year, slightly less of a lower rate in the second year, and then you'll pay market rate in the third year. The hope, of course, being that you'll be able to refinance in that time. From what I understand, this product requires a buy down, but you as a buyer are in a position to ask your sellers for a credit to pay for that buy down. And if you're a seller, you may wish to consider offering a credit for this type of loan product to help any potential buyer pay list price. You can also explore adjustable rate mortgages, which gives you the ability to change rates based on the current market rate rather than being stuck with a fixed rate. A lot of people right now are advising that you marry the house, date the rate, and if you're renting, you divorce the lease. And I get it. The idea is that you buy something with the anticipation of being able to refinance in the future. But it's a little hard to fall in love and marry the house when it's missing a bedroom, it doesn't have a backyard for your dog to play in, or it's in a less desirable neighborhood than you'd hope. Now, if you're willing to compromise, maybe buy a fixer-upper or buy something smaller than you would expect in the anticipation that it will be a rental, or you want to buy a multifamily property and a house hack, then you can use this current market environment to really come out ahead. And to the renters out there, you may be weighing the pros and cons of renting and concluding right now that the risk of your equity being wiped out is too high to buy right now. But remember that the alternative is effectively a 100% interest rate indefinitely if you choose to continue to rent. It's no secret that on average, homeowners have higher net worths than renters because in the long term, owning real estate makes people wealthier than they would have been if they didn't own real estate. Sticking with mortgages and looking at mortgage application rates. This is a huge leading indicator for the overall housing market. Here's what the Mortgage Bankers Association have to say about the current situation in their most recent survey for the week ending November 4th. Mortgage rates edged higher last week, followed by news that the Federal Reserve will continue raising short-term rates to combat high inflation. The 30-year fixed rate remained above 7% for the third consecutive week, and there were increases for other loan types too. Purchase applications increased for the first time in 6 weeks of declines, but remained close to 2015 lows, as home buyers remain sidelined by higher rates and ongoing economic uncertainty. Refinances continue to fall, with the index hitting the lowest level since August 2000. No surprises there then, higher interest rates stifle economic activity. That's what they're supposed to do. Interesting that there was a small increase in purchase applications there. It just goes to show that people are going to buy homes regardless of economic circumstances. The people I feel most for in all of this is the first-time buyers that were pushed to the sidelines in 2020 and 2021 because they couldn't compete, and are now again on the sidelines because they can't afford the interest rates. A lot of people consider home ownership to be an integral part of the American dream, and it seems like this dream is not becoming a reality for a lot of people. I wanted to look at one news article really quickly revealing more insight into the mortgage industry. Wells Fargo reported a 90% drop in originations, and mortgage staff are preparing for layoffs. Let's move on and look at the Spokane market itself. I like to include Spokane at the end of the data section in these videos. The reason being is it's really nice to get a picture of the overall national market and to see if our local market here in Spokane is reflecting that. If it's not reflecting that in any particular way, then we can ask the question, why is that occurring? The Spokane Association of Realtors has changed their format a little bit, but the information is still clear. These are actual sales for October. Sales were down 33.7% year over year, which tracks national year over year decreases of 31% and the Western region's year over year decreases of 38.7%. Median home prices continue to rise on a year over year basis and are up 6.3%. But they currently sit below $400,000 for the first time since February 2022 and are at $395,000. It should be said that median home prices have dropped $55,000 since their highs in May 2022, which represents a 13% decline since the May highs. I attribute some of those declines to seasonality, but as we can see from this graph here of median home prices in 2020, 2021 and 2022, this decline seems to have started much sooner and appears to be much steeper than previous years. Inventory is up to a 2.2 month supply. It's worth mentioning that a balanced market would look something like a 3 to 6 month supply, so that gives you some idea that we're not over the low inventory phenomenon just yet. We've just masked it with high rates. If rates were to drop to 3% again tomorrow, Demand would rapidly consume that supply, and we'd be back to a low inventory environment and bidding wars. We still need to be thinking about increasing supply for the long term by building more homes. New listings are down 17.1% on a year-over-year basis, which is exactly what the first economist mentioned is happening nationally. This means that overall the Spokane market is tracking the national market almost exactly. I want to point this out because some people believe that Spokane has been acting as a bit of an outlier, rising too high too quickly over the last couple of years and becoming what many people believe is overvalued. I put that term in quotations because that term came from a study conducted by Florida Atlantic University, which based its research on Zillow figures. In my opinion, this was a poorly conducted study, and I believe this to be the case because they relied on the same figures produced by Zillow's algorithm that caused Zillow to lose billions of dollars in their iBuyer program because they weren't able to value homes properly. During that time, however, median home prices here in Spokane tracked national median home prices in terms of the rate of growth and the actual dollar amount almost exactly. And it appears right now that Spokane is behaving exactly like the national market in this declining market. Now I wanted to touch on a few news articles that have stood out to me this month. Inflation is still over 8% and the Fed is continuing to increase interest rates. But it's not inflation or the Fed funds rate that has really caught my attention this month. No, it's the number of layoffs and hiring freezes that I've been seeing from large corporations. Apple, Amazon, Intel, Meta, all announcing layoffs and hiring freezes. This feels an awful lot like a recession. So my sole focus right now in the macroeconomic space is how long before the Fed pivots from its current focus of inflation towards cutting rates and stimulating the economy to combat recession. That will mean lower rates and economic stimulus once again. Interestingly, BlackRock is of the same opinion. For those of you that don't know, BlackRock is the world's largest asset manager. And for better or worse, they are real market makers. If BlackRock says jump, then the Federal Reserve will likely ask how high. And they are quoted as saying before the last Fed meeting that they expect rates to rise 0.75% and to hear pivot language. They also anticipate 2 smaller hikes before the Fed pauses its rate hikes at around 4.75%. And honestly, if BlackRock says it, then the Federal Reserve will probably fall in line. I don't always agree with BlackRock. I think they're doing some very damaging things to this economy, particularly by buying up single-family homes and turning them into rentals, but they are undeniably an enormous player in the overall economy, and I think they're probably onto something here. Now, I included a lot of news articles throughout this whole video, so I'm only going to include one more news article in this section, and it's Spokane specific. The Housing Action Subcommittee is discussing a draft ordinance aimed at regulating residential housing. The ordinance would require landlords to get a business license to rent more than 2 units, annual registration of rental properties with the city, and mandatory online training for landlords. Some protection for tenants include requiring property owners to provide an information packet of their tenants' rights and responsibilities, routine and periodic inspections of the property, anti-retaliation protections, and a tenant legal fund. The ordinance would also begin to establish a universal background and credit check system for the city, so prospective tenants don't have to pay for multiple checks while searching for a unit. Now, I would say that setting up an LLC for your rental property is good practice and will probably require you to get a business license anyway. But everything else on that list is just unnecessary. We have a housing crisis here in Spokane, according to the mayor. Landlords provide housing, and they do that at a cost. Part of that cost is navigating red tape. The more red tape that landlords have to navigate, the higher that cost of providing housing will be. That has been proven true time and time again in many different markets. And that will be the direct effect of this ordinance and similar ordinances in the future if they do go into effect. It's also totally unnecessary. Washington is a very tenant-friendly state, and there's a lot of regulations and laws protecting tenants already. We don't need additional bureaucracy from the city of Spokane too. Now let's piece all this information together and summarize the market as we see it right now in November 2022. The big news is that interest rates are extremely high and have broken through the 7% mark. Inflation is still far too high. and home prices are beginning to come down. Nationally, pending home sales were down significantly on a month-over-month and year-over-year basis. In terms of Spokane specifically, home sales are down, and we continue to have low inventory, though that situation is improving slightly. We're now at a 2.2-month supply. Prices here in Spokane are up on a year-over-year basis, but the median home price has dropped $55,000 or 13% since their highs in May. This seems to have started earlier and be steeper than normal seasonality could explain. In my opinion, the market continues to be unsettled and unhappy. When the dust settles and inflation returns to around 2%, if in fact it does at all before rates come back down, it will be extremely interesting to see what the state of play is at that time. My money is on pent-up demand being released, inventory reducing dramatically, and us returning to an inventory shortage with bidding wars yet again. If you're a buyer right now, do your own calculations, but you may find it's more beneficial to offer $30,000 below list price at 7% than it would be to pay $100,000 over list price at 3%. When rates do come back down, you could be in a position where you're sitting relaxed in your new home, waiting for your refinance to go through, when everyone else is scrambling around trying to buy a home when rates do eventually come back down. If you're a seller, know that homes are being sold still, but it will take you a lot longer to sell your home than it took your friends to sell their home this time last year. You will have to prep your home thoroughly for sale. You'll have to price your home fairly and come up with a strategy that may include price reductions. But it is still possible to sell your home. I sold a home just this week at only $10,000 below list price. Yes, it took us 30 days to get there, but we got there. That's it for this video. I hope you gained from this video. If you did, please like and subscribe. That really does help me out. If you have any suggestions for how I can improve these videos, or you want me to include something that I haven't already included, then leaving a comment down below. If you're looking at buying or selling real estate here in the Spokane area, then please get in touch, give me a call, shoot me a text, or send me an email, and I'd be honored to work with you. Like I said, my name is Phil Wells, and thank you for watching.